accounts people, time to have a look at financial statements, focusing on the requirements for the financial accounts prep unit at AAT level 3. Going to focus on the difference between sole traders, partnerships and limited companies. In this video, looking quickly at extended trial balance, then mainly onto statement of profit or loss. We're going to use the same basic figures, so the numbers will look fairly similar, but with the difference in company structure, some of the numbers show up slightly differently. I'll do the statement of financial position in a separate video. Quick overview first. Sole traders and partnerships, we prepare them for the individuals involved, mainly so they can complete their tax returns. They're going to be paying income tax themselves on the profits. Limited companies, completely different. They're prepared by the directors with, of course, the help of accountants, to the shareholders in accordance with Companies Act 2006, and notice all the rules coming in, and regulatory frameworks, international financial reporting standards, and as far as level 3 is concerned, international accounting standards. We look at 3, 1, 2 and 16. The sole traders and partnerships usually have far more detail. This is because we're providing useful information as with the guidelines, so that they can understand the financial part of their business activities. They might be the best hairdresser, best plumber, best electrician, best IT consultant around, but they're not necessarily understand the financial part of the business. That's our help required. If they are very good financially astute, they'll understand this a lot more, and therefore in a few years' time they'll be a lot wealthier as a result. The accounts don't need to follow the structure in IAS 1, and in particular there's no cash flow statement, no changes in equity. All accounts must, of course, though, be ethical. They must be verifiable. They must be comparable, consistent, and all the other qualities that we need and expect in a good set of accounts. And there is a very old saying, a good set of accounts hides as much as it shows. Well, it will be obvious when we get to the statement of profit loss for the limited companies how much information is hidden. So on with the exercise. So this is our exercise. It's an old extended trial balance question. The answers to it, borrowed it from an old BPP one. So routine trial balance with lots of adjustments, but because I've already divided it into statement of profit or loss and statement of financial position, I've got my profit figure, which means when I complete my template I'm effectively double checking my mathematics. I know what the profit figure will be. My partnership has a few changes. We've now got the 3 partners having capital accounts. We've also got the 3 partners having current accounts. In our trial balance you see the opening balance, but here the closing balance is after drawings and profit share. In other words, after the appropriation has been done, and the drawings exist in the trial balance. They incorporated into that figure. So the single row has disappeared. This is now profit or loss available for appropriation. Only one figure here, because the other 20,007, what would normally be a credit entry here, again it's incorporated into the current accounts. Our limited company extended trial balance, very similar, but we now have shares instead of capital, and the business keeps the money that doesn't go out in form of tax and dividends, so adds to the capital, so retained earnings. It's 5,400, so a total equity of 45,400, because we haven't got the drawings figure that was in the sole traders account. Then we also have this issue down here, the taxation as an additional expense. This is because the business itself has to pay some tax, and it's sitting as a liability at the end of the year because it won't have been paid, and you can see the profit has been reduced by that 4,100 as a result. So this is the template we're going to do. I've hidden 4 columns because we don't need the adjustments on the initial trial balance. This is a column we're interested in, and we can put the figures straight off here into here because I've already populated it with the items. So admin expenses first. Then we need our distribution expenses. Discounts allowed, very healthy discounts allowed. And our discounts received will belong here. It's income but not revenue. It's a reward for paying our suppliers quick, not for trading. Purchases are part of cost of sales. Allowance of DD adjustment. This is a debit, so it's an expense, so it will belong here. The adjustment goes in the profit and loss, the most common error on extended trial balance at advanced bookkeeping. Had it been a credit entry, we'd have added it in here to our sundry income. The only other item you're likely to see in sundry income is gain on disposal. Sales figure, right at the top. Those, I know there isn't any sales returns, so we can just subtotal those. We got two, got there, done that one. Opening inventory, opening inventory is part of our cost of sales, and our selling expenses is down here. Wages, expense, and for depreciation we've just got two separate items. We've only got one row here, so I'll just add the two together. And we've got our closing inventory, statement of profit or loss. So minus, because we need a negative figure showing there. And lastly, irrecoverable debts expense down here. And that should be all the numbers, which means we can double check that it all adds up correctly. So cost of sales, and then our gross profit is revenue minus cost of sales, we've only got the two by subtotaling it, and that makes life easy because we can just add these up to get our adjusted gross profit figure. Our expenses need subtotaling. And then our net profit or loss should be our adjusted gross profit minus our expenses, and it is, and we know that figure is correct because we've got an extended trial balance. Might be a few variations on the format. Some people do it in a single column, and sometimes you'll just see cost of goods sold. Partnerships, very much the same. In fact, from here all the way down, which is why I've already filled it in, nothing has changed one iota. It's now called profit available for appropriation, it's got a different name. Because in this question we haven't got any salaries, we haven't got interest on capital, we haven't got interest on drawings, the amount of profit share they're going to get will just be a third. It doesn't say any other ratio. These items and the appropriation, more detail on other videos. So if we do L 39 divided by 3, it adds up back to 20,007. So that is just one difference, the appropriation account as we split it up between the three, and then that figure is incorporated into the current here. So our limited company account last, so again we'll just quickly hide the adjustments and original figures. So this is going to be a little bit harder to work out in order and much easier to miss items out, because we only have 4 cost figures. We have cost of sales, distribution and selling cost, admin cost, finance cost. Then we've got our taxation charge to put in. But we've got lots more expense figures, so there's more items going into each of these individual calculations. Let's see how it works out. So the revenue, though, that hasn't changed, and we didn't have any returns, so we can just put the figure in. You wouldn't see sales returns on a limited company very often. So our cost of sales is our opening inventory plus our purchases minus closing inventory, and then our gross profit is our revenue minus our cost of sales. Then we have distribution and admin costs, each of which is going to have lots of different items, so we'll go back to here and make sure everything fits in now. Admin expenses, well, that's easy to start off with. That'll go into our admin costs. Our distribution expense, also easy. Then we get to the ones that haven't got a natural place. So quite often, if it hasn't got a natural place, we put it into admin costs. As long as we're consistent and we explain what we do in our company's accounting policy, it's fine. It's not material, it's not going to change anything. It's not going to change the profit from operations as long as it belongs above the operations line, i.e. it isn't a finance cost or tax cost. So these figures are, in fact, that cost of sales is actually going to get adjusted later as we put more items in here. So the first one that we didn't know where it belongs automatically is discounts allowed, so we'll put it in. Perfectly good place for it. And now we've got our discounts received. No natural place, but that's fine. Purchases were in the cost of sales. Allowance for doubt for debts adjustment, another item that had its own row before, but now we're going to just add it into admin costs. We've put the sales, we've put the opening, selling this expenses and not admin. They can be added nicely because it is in the IAS admin, selling and distribution costs. So we'll put that into our distribution. Wages, bear in mind these are employees' wages. Well, quite often in an exam question you'd have a breakdown. So much goes to one cost centre, so much goes to another. So failing that one, we'll just put them in admin. Now we've got our depreciation, so our motor vehicles. So in a level 4 exam you get used to percentage to cost of sales, percentage to distribution, percentage to admin. Well, I'm going to assume our motor vehicles are our vans for delivering items and just put the depreciation for the motor vehicles into our distribution costs, and the machinery is part of our cost of sales, so that would change that figure from partnerships or sole traders. That will increase the cost of sales, reduce the gross profit. And we've dealt with that. Irrecoverable debts, get another one that almost certainly will always go into admin costs. And equals, not sure why that did that one. And now taxation charge has got its own place. So hopefully we can now add this up. So our gross profit was L9, take off the distribution costs, the admin costs to get our operating profit. That figure we've seen before. Finance costs were 0. It would have been profit from operations minus finance costs had we got any. Then we've got our tax charge. So our profit before tax minus our tax is our profit for the year from continuing operations. Comprehensive income is usually revaluations, level 4 topic, where property that's been owned for a number of years has to be revalued because it's gone up consistently or significantly in the accounts, and that just gets added back in to the income of the business, and that's our figure from here. So just remember, lots of items in here. Got to get into the habit of doing it. You won't have one of these questions at level 3, but it is useful to know the difference and how items are represented differently.